Hey, what's going on, everybody? It is Wednesday, August 21st. The market was up today, kind of reversed some of those losses, tiny, small losses yesterday. We had the Fed minutes that came out today. Look, everything is being framed right now as an approaching rate cut. I mean, we know this. Like everybody is just, on pins and needles, waiting for this approaching rate cut. And anything that happens or anything that is said or anything that is reported is always kind of framed in the perspective that, hey, there's a rate cut coming. Meanwhile, we saw how expectations went from, remember a couple weeks ago when we had that 1,000-point decline? I'm going to talk about that in a second. And everybody was like, we need an emergency rate cut. Right now, we need an emergency rate cut. Then it was like, okay, we'll do 50 basis points in September. We'll do 50 in November. We'll do another 50 in December. Now it's like 25 basis points at the September meeting. Not by a big percentage margin either. I mean, but, that was like, 50 basis points was like 99.9%. Now at 25 basis points, based on where Fed fund futures are, it's like 65%, something like that. Anyway, what I found interesting today was that the Labor Department came out with a revision of job gains in the last year, okay? And they revised down by 818,000 payrolls. That was the biggest downward revision since 2009. And if you remember 2009, that was the GFC, the great financial crash. It was a recession. So we just had the Labor Department come out and say, hey, wait a minute. We didn't have as many jobs created as we thought. We only had 818,000, almost a million jobs less. Okay? And everybody was like, cool, we're fine with that. Let's buy the market. Now, if you remember, I mentioned like 2 weeks ago, we had that 1,000-point drop in the Dow. We had, it was the worst day in over 2 years. And that was triggered by 1 week weekly employment claims report that came out the prior Thursday, all right? And everybody was freaking out because they said, oh man, the economy's slowing down. We better dump stocks. So we had that 1,000-point decline. Since then, we know the market has bounced back. And today we have a revision saying, hey, 818,000 jobs had to be removed from the data because that was never created. And we know that the economy, is slowing down. Atlanta Fed right now has a 1.9% third quarter GDP growth rate, blah, blah, blah. I've been telling you all this stuff. What's interesting to me and what I like to observe when I can and point out to you guys when I can is when I see these contradictions in behavior or contradictions in rationalization, like how things are explained. 2 weeks ago, the slightest little indication of a slowdown in the labor market with a weekly initial claims number that was higher than expected caused a 1,000-point drop in the market. Now you get an 818,000 downward revision, the biggest downward revision in actual job creation since 2009. And it's like, yawn, no big deal, let's buy the market. The reason why I like to look for these contradictions is because they are an indication, they are a sign of pure emotion. That any kind of analytic perspective, like solid analytical perspective. And you don't have to go along with my analysis. If you think there's better stuff, if you like to do, or if you like to follow what mainstream economists follow, which is these monthly numbers that the government releases, fine. Whatever your analytical framework is, no problem. Do it. What I'm saying is you have to be consistent. You have to stick to it. If you don't stick to it, and you're flip-flopping around to try to curve fit, just, so you can never be wrong, that's just not analysis. That's just kind of, deluding yourself. So like when I see contradictory behavior or contradictory rationalization, like 2 weeks ago, a bad initial claims number was enough to trigger a 1,000-point sell-off in the market. And now you get this massive, downward revision that we haven't seen in 15 years. And it was like, oh, that's no big deal. Not to mention the fact that we had already several downward revisions in the Atlanta Fed's third quarter GDP forecast, which I forget when it first came out, like right at the beginning of July. So like to me, it's just like, it's a reflection of an attitude that people want to buy no matter what. They want to buy no matter what. And that is not, that you might say, well, Mike, what's wrong with that? If people want to buy, the market's going to go up. But I'll tell you why, because that is not in any way a savvy way to invest. That should tell you the quality of the investor right now. And that's very, very important. I have this thing in my MMT Trader report. For those of you who are subscribers, you know what I'm talking about, where in every week's report, I go through an analysis in a number of different futures markets like oil and gold and silver and the S&P and bonds and stuff like that. And I break down the action or the commitments, the participation, the moves being made by producers and banks, which you can call, the smart, well-capitalized money. I've talked about on my channel here, I've done many videos on how I always look at, especially when it comes to physical commodities, I always look at what producers are doing, because they're in the business of producing the commodity, merchandising it, distributing it, whatever. They really have their finger on the pulse of what's going on. And whereas these speculative funds, they're mostly guided by sort of technical systems, okay? They're not, and I know this deeply, because when I had my floor brokerage operation on the NYMEX back in the 80s, 1980s, I had oil companies as customers that I would execute orders for on the floor of the exchange. And let me tell you, they were always right, okay? Whenever they came in on one side, and it was usually pretty often when I saw the pit or the traders in the pit, the independents going one way, the big guys, the producers, would come in and go the other way. I always pay attention to that. And so this is another one of these things that you want to pay attention to. When you see a sign of a lack of quality or a lack of analytical discipline, and it doesn't matter what, I'll say it right now. You don't have to take my analysis. It doesn't matter what your analytical framework is. I want you to be consistent with it. That's all. We're not always going to get it right. Nobody's always going to get it right. There are going to be things that happen. There could be stuff completely unseen that comes out of left field that could cause a reaction in markets, maybe short term, maybe medium term, that goes against the fundamentals. Doesn't matter. I want it to be consistent. When you have, behavior and rationalization based on a set of criteria, and that is like fundamental. You have people sticking to that. You have them talking about that all the time, all right? And then it flips around, and all of a sudden, like, well, that's not any good anymore. We're going to go the other way without any explanation as to why. I could even understand, like, if you flip it around and you say, you know what? We went back to the drawing board, and we understand now that there were some omissions or some things that we left out in our analytical process, and we had to change that. That's fine. That's the scientific method, right? But you don't see any of that going on. You don't see any of that going on. All you see going on is like a kind of a blind desire to buy the market right now because there's a rate cut or potentially 2 or 3 rate cuts coming this year. And again, this is the same monetarist understanding that we saw with the rate increases, which I told you was going to result in a record stock market rally and a very strong economy. None of that was in any of the narrative or the forecast at the time. Everything was, there's going to be absolutely a recession. The stock market's going to crash. You had this guy from Morgan Stanley, Mike Wilson. He was out there all the time. Even when we were down at the bottom in October 2022, and I said, that's the inflection point now. Now is when it's turning. This guy was like, we're going down another 20%. And he waited all the way until early this year. I forget, I don't think it was even in January. It might have been in February or March when he said, it's okay to buy the market. I happen to think that we're going to see a pullback that will take back the gains that we've had since March, okay? I think, like I've been saying, a lot of interesting things are going to happen once these rate cuts, because now these rate cuts represent a change in, kind of the picture of what's going on. A change in the dynamic for the first time since March 2022, when we had that change in the dynamic when the Fed started to raise rates. And I think a lot of this rate cutting, at least for the remainder of this year. And then it gets very interesting next year as the rate cuts continue, because I think they will, because it sets in motion kind of a self-sustaining effect. I've spoken about that. The rate cuts lead to a slowdown in fiscal transfers. It lowers the general price level because the cost of credit is reflected in the cost of all goods and services. So the general price level comes down, AKA the inflation rate comes down. The Fed sees that, it cuts again. It happens again, the price level comes down further. The fiscal transfers are reduced even more. Fed cuts again. So it's like a self-sustaining cycle, all right? And so it's going to get very interesting in 2025, on top of the other things that are going to happen in 2025, like a much smaller increase in the cost of living adjustment for Social Security. All right, don't forget the last couple of years. Last year we had a massive 9% increase in the COLA, the cost of living adjustment for Social Security, military pay, veterans benefits, all those things. This year it was a little bit less. I think it was quite a bit less. It was like about 3.7 or 4%. Next year it's going to be like 2 something. Okay, so a slowdown in those transfers, a slowdown in the interest income transfers. And it won't even be a slowdown necessarily. It could be like a drain. Depends on how far the Fed goes. But I did some, I think I mentioned here, I did some back of the envelope calculation, like 1.25%. I forgot what the number is, but it was substantial, okay? It was substantial. So it's gonna, like I keep saying, it's gonna get interesting. It's gonna get very interesting. But again, I just want to point out that one of the things I like to look at are inconsistencies where, it's kind of like one of these things where people just like throwing in the towel saying, forget it. I'm just buying. I'm just closing my eyes and buying. And that typically, when that happens, it happens the same like when people just like get fed up and scared and they just sell everything. What is that usually? That's the bottom of a bear market. When people can't take it anymore, when the pain becomes too bad that they're like, sell everything. And now you're in this situation where it's like, no matter what happens, it's like, that's a buy signal, okay? Economy's weak, that's a buy signal. Economy is strong, that's a buy signal. Whatever, that's a buy signal. Okay, so again, it speaks to the quality of the investor right now. And that's about all I could say on that. So we are in the like I mentioned last week, and I've even prior to last week, I said the fiscal flows for this cycle are peaking out. By the way, I forgot to mention again, I always forget this. Please like and subscribe. If you've done that already, thank you very much. If you haven't, please do that. It helps the channel a lot. And I appreciate it very, very much. Sincerely to all you guys who have been doing that. So yeah, I mean, I keep repeating, like, I'm looking forward to it. I'm excited about it. Because it's going to be another one of these situations where, I mean, it's fun. Because you're going to get this whole mainstream of economics again that can't figure it out. And you know what they're going to say. You absolutely know what they're going to say. They're going to say, well, you know why the economy's slowing down, maybe even going into a recession? Why? Because the Fed waited too long, right? The Fed waited too long. So there, again, you're going to have them, instead of going back and trying to think like, why was it going up and expanding with 10 rate increases? And why is it going down now? They're not going to go back and kind of think about their theory. They're not going to reflect on it. They're just going to, make up some excuse that, the Fed waited too long. I'm telling you, and what I'm telling you is exactly, and we'll come back and we'll talk about it because it'll be out there, believe me. It'll be out there everywhere. On the internet, everywhere, on CNBC, they're gonna parade the analysts, across the television. Every single one of these guys from Wall Street are gonna say the Fed waited too long. And when the Fed hears this, when Powell hears this, and I don't know who's gonna be president. If Trump is president, believe me, there's gonna be major, major pressure on Powell. If there's a recession when Trump is president, I mean, Powell's going to be read the Riots Act by Trump. I don't know what Harris will do, but, he's just going to be under a lot of pressure to cut. That's when things are really going to start to get wild. And again, I can't wait. Anyway, that's it for today, folks. Don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial, MMT Trader. You want to be on board because the ride's gonna get pretty scary. It's gonna be fun. It's gonna be a fun ride. You want to be on board. All right, see you tomorrow. Bye.